Hey folks, the weekend is here and we're back with your favorite weekend show, Smart Money. Now this week was historic for the markets, right? With the Sensex scaling that 50,000 mark and the Nifty also hitting record highs. The most popular question on social media has been, what do I do with my money? So we're going to tell you how to approach your mutual fund investments when the market is at an all-time high. Should you liquidate? Which are the funds to invest into? And how do you sort of decipher, which fund is good, which fund's NAV will perform? All of these questions answered with Feroze Azeez from Anan Rathi Private Wealth Management, who joins me now on the show. Feroze, thank you so much for being with us on the show. This is the most popular question that we get asked all the time. Which are the best or the top 10 mutual funds to invest into in this new calendar year? So let's begin from the top. What is the criteria when you select a mutual fund? I mean, what are the most important tools to use while selecting mutual funds?
Good afternoon, Sonia, and thanks to have me on your show. Like you said, Sonia, this is a very popular question. What are the funds to invest in? If you have a laundry list of funds to invest in, you almost have about 500 of them. You have to make a choice of the 8-10, which are going to form a part of your portfolio. So there are three different methods in which you can choose a scheme. One method which is very popular amongst investors is to see the past performance or the track record in isolation. That's method one. Method two is to see some degree of risk reward. That's the method two. The third method is a combination of trying to see the futuristic performance parameters and also some ratios which give you what kind of risk the fund manager takes, he or she takes, or the efficiency of the portfolio. So there are three different methods. The most popular one is not very good because that's looking at the rear view mirror, and seldom has it helped people make money because they will be chasing their own tail. So the third method is what Anand Rathi strongly believes in, and for the last decade we've been adopting that, and that's a little ahead of the curve.
Okay, so you're busting some myths here, right? You're saying that if you look at past returns as a method to pick your fund, you're perhaps not doing the right thing. So tell us a little more about what are the important parameters beyond looking at returns when you evaluate a mutual fund.
There are four criteria, Sonia, which you can use in choosing funds. The fund, if it performs on all these four criteria, if it fares well, then that's definitely a scheme which would be more robust. So, of course, there is return. In return, before I go to the other three, in return, people generally look at trailing return, which is if somebody wants to invest and wants to look at the last 2-year return, he or she sees the exact 2-year return from the day the fund is being evaluated. That's called the trailing return. So there's another more popular method which gives you a more in-depth performance research, which is called the rolling return. So that's, of course, return. Rolling return gives you different time frames, not just one. So if you want to find out the rolling return, you can find out 12 different investors' return and then get a sense. Now going on to your pointed question, Sonia, which are the ones which are beyond return? One is the down capture ratio. This basically tells you how much would the fund manager capture the downside, by which you mean if the market takes a U-turn, which is very important in the contemporary situation where you are at highs, if the market was to backtrack 10-15%, which is the fund which will fare the best? That's measured in a ratio called the down capture ratio. For example, if you look at a DSP midcap, which has one of the best down capture ratios. So if the market falls 10, this fund has an attribute of falling only 5 and 6. So that's the second, Sonia.
Okay,
the third is risk and reward.
Let me try and interrupt you on that, Feroze. So down capture return, right? You say that an investor should check a fund's performance in times when the market has delivered negative returns. Like, you gave the example of DSP midcap. How do you do that? I mean, which are the tools that you use to sort of track these funds, and how do you make sure that a fund is sort of outperforming the market?
See, there are softwares available, but if I have to give you a brief of what that software ends up doing with the huge amount of data it has on a daily basis, it tries to finds out pockets, Sonia, where the markets have done bad, and only takes those zones where the markets have actually fallen, and then evaluates what was the fund return, and then sees in all those time frames when the market was down, which fund fell the least. That's measured in a variable called down capture ratio. Fortunately, technology helps us do the dirty, intensive task of looking at everyday data and arriving at that number.
Okay, so you are perhaps the man for the job to do all that, Excel sheet work and sort of pick up the, best mutual funds to invest into. But coming back to the parameters, you said one is rolling returns to measure funds' historical performance, right? Which you said is not the best way to sort of identify which fund to pick. Down capture return is one, and risk reward of the fund is another one. Which is the fourth one? I mean, are there any other parameters that you look at while picking a mutual fund?
Yes, the fourth one is more futuristic in nature. Just like Sonia, if one as an investor buys a stock, the most important thing which he looks at is what's the target price of that stock. But when it comes to funds, most investors don't evaluate this. That's why at Anan Rathi, we find out the target NAV of each fund. See, a fund is nothing but a combination of stocks. So if a stock can have a target, why can't a group of stocks also have a target? So we go down to each stock and find out what's the target price for each stock by the best analyst in the country, which is published information, and then you arrive at the target NAV. So this has proven to be very futuristic and not only looking at past performance. So this fourth criteria helps you gauge the potential of the stocks which currently constitute to come together to become your mutual fund.
Okay, so those are the four parameters that you look at. But I think, a lot of our retail investors watching us right now want to know which are the funds I should put my money in, right? Because as you said, people don't have these elaborate softwares. They don't have these Excel sheets to sort of key in all the data. Since you've been doing a lot of the dirty work for us, tell us, if I had to put some money to work now for 2021, which are the best equity mutual funds as an investment opportunity for the long-term investor?
Wonderful. Yeah, you rightly pointed out, Sonia, not so much of in-depth research which each of us can do on an individual basis. That's why we have shows like Smart Money who can give them a direction, I must say. And then let me rattle out these 8 schemes first, because those come from a basket which is more futuristic. The other 2 have a little contrarian kind of an opinion. So let me say the first 8. Axis Blue Chip is for the first one. Axis Blue Chip, why in the large cap category that's a good scheme? Because there are 2-3 unique things the fund manager does. He has taken cash calls, which not too many equity fund managers do. And at these levels, it's very important for you to have the fund manager's agility right up there. Second is there's a focus, so he has only 25 stocks. So that's the uniqueness of this Axis Blue Chip as the first pick in the large cap category, Sonia.
Okay, so that's the first fund that Anan Rathi believes is something that will give you great long-term returns, Axis Blue Chip. You want to just take us through these, we have the graph on the screen, so I just want you to take us through the numbers that you've put across rolling returns, down capture return and efficiency ratio. Just want to explain to our viewers what these criteria mean in terms of the numbers that you've allocated.
Yes, Sonia, what it means is, on all these 4 parameters, if you see Axis Blue Chip, for example, is number 1 on rolling return. Rolling return in the sense, not just one investor's experience, but several investors' experience has been good. And it's number 1 out of all the large cap categories. In efficiency, which is risk to reward on the base of risk, is also number 1. And number 1 again is down capture ratio. In the target NAV, it ranks 14, which implies that it doesn't, the future stocks might not be, the stocks which he has have rallied up significantly already. But since the fund manager is very agile and he's making changes, so you're okay. So this is how you read that data of how are they ranked amongst the 14-15 schemes which are there in the large cap category above a certain AUM, which is 1,500 crores.
Okay, great. So what if I just want to sort of recap what you said, Axis Blue Blue Chip is a fund that you feel would be great for long-term investors. A, because the number of stocks that the fund manager has chosen are restricted to 25, so he's not spreading himself too thin. And B is that the fund manager himself is very agile, so he's sort of changing with the times. Just for the benefit of our viewers, it's a ranking. So number 1 is best, and of course, as we progress forward, it worsens. But let's go back to that first slide. So we spoke about Axis Blue Chip. What are the other funds? I notice you have Canara Robeco, there's Mirae Asset Large Cap, there's Franklin India Blue Chip. You just want to take us through why investors should look at such funds?
Yes, so Mirae Asset Large Cap, again a consistent performer. The uniqueness of this fund manager is he's doing too much bottom up. So basically this fund manager sticks to similar weightages as the benchmark with respect to sectors, but has done great job choosing the best performing stock in that sector, which is called bottom up approach. That's what has made him the consistent performer for almost about 6-7 years. We've been recommending Mirae for the last 6 years when it was a very tiny asset management company. So I continue to believe that the performance which the fund has delivered has a very good foundation to continue as well, and not just in the rear view, as we called it. And the next one in the large cap category, if I have to finish the large cap category, it's the Canara Robeco Blue Chip. Canara Robeco Blue Chip has exhibited very, very courageous decisions and stuck to the best performing sectors. For the last 1 year, for example, it's taken IT, financials and healthcare has been the maximum weightage, which was a little contrarian to do 1 year back in Jan last year. But I think they've got their calls right on the sector, unlike Mirae, which is just the opposite. Doesn't take sector calls, but takes stocks calls. And that's why your large cap portfolio should have schemes which are not me too. They're diverse in nature and their behavior.
Okay, that's actually a very important point. So 2 different fund managers, right? One who takes sectoral calls, and of course the big sectors have worked for them, IT and finance, and one who takes stock calls where their stock returns have worked. Now, for our viewers, this is only the list of large cap funds that Anan Rathi is recommending: Axis Blue Chip, Canara Robeco, Mirae Asset and Franklin India Blue Chip. If you want, peaceful sleep at night, you don't want to do a lot of the heavy lifting, the hard work to research funds, that's the list. But what we're going to do is we're going to take a short break. When we come back, we're going to focus on mid-cap funds and small-cap funds, because that's where all the action has been. Don't go anywhere. This is a masterclass on how to pick mutual funds and what are the top 10 mutual funds to invest into in 2021. We'll be back. Welcome back to Smart Money on CNBC-Tv18. If you have funds to invest in 2021 and you've been confused where to put it, we are here to sort you out. Today on Smart Money, we're speaking with Feroze Azeez from Anan Rathi Private Wealth Management. They've done a lot of work and have come out with a template on which are the 10 best funds to invest into in 2021. Just to recap, these are the top blue chip funds that they are recommending. Now let's move on to the mid cap and small cap funds. There's been a big party there, right, Feroze? If you had invested in any mid cap fund in the start of the lockdown in March, you would have made a minimum of 30 to 35, maybe some even 40% returns up until now. So tell us, in 2021, which are the top mid cap funds to invest into?
Sonia, the mid-cap funds, 2 of them, let me tell you, and there the criteria is to see those fund managers who have the best stock picking capability, who smelled businesses much before the market realized they were very good businesses. In that category, DSP mid-cap and Kotak emerging equities. These are the 2 mid-cap schemes. Both the fund managers have picked up very, very good stocks much before the industry did. For example, DSP midcap, Vineet Samre picked up Solar Industries, AIA, and all these stocks when nobody in the institutional space was picking it up. So these are the 2 schemes, to my mind, still have the potential to give stupendous returns going ahead if the holding period is 3 years plus.
But, I was noticing the target NAV for DSP, Midcap and Kotak Emerging Equity is quite high. You've put 9 and 11, which means that these are the stocks that have already rallied. Does this mean that, you're entering sort of late into these funds? I mean, the low-hanging fruit has already been picked. Is that the right way to look at it?
See, I think what happens is, as long as these businesses are growth businesses, those targets get revised on every financial year basis. So I don't think we're too late as an investor who's entering it. The reason being, there are two reasons. One is, after the financial year, then you start looking at estimates, analysts start looking at estimates for the next forward year earning. And then your price targets go up, and all these businesses are very high growth businesses, being in the mid-cap space, one. And second, in the mid-cap space, the churn ratio of the fund is higher. The fund manager changes the schemes, changes the stocks more rapidly than in a large cap. Because the kind of universe the guy operates in is larger than in the large cap space. So I'm reasonably positive that there is headroom. With respect to time, that target anyway gets revised as time progresses and the next financial year's approach.
Okay, so these are the mid-cap funds that you can look at. There are some multi-cap funds as well that Anand Rathi is advising. So that's the list here for you on your screen. There's HDFC Equity, SBI Focused Equity, Canara Robeco. Now, in a market which is already at 50,000, are you advising putting money in multi-cap funds, or is it better to stick with some of the large cap names? Feroze?
Sonia, I think multi-cap schemes have a reasonable skew towards large cap. So I think their performance has a reasonable linkage to Nifty, so that doesn't worry me. And as long as you have a moderate exposure in the form of mid-cap schemes, which is only 2 of them, then you are anyways overweight large cap. And the entire combination which we are in the process of reading out will ensure that 65% of the money anyways goes into the top 100 listed stocks as per market cap. So it doesn't worry me. So in the multi-cap space, let me quickly, for the lack of time, read it out. Kotak Equity Opportunities and Canara Robeco Equity Diversified Fund. These two in the multi-cap space show very, very good signs because both of them follow very different philosophy. One of them is pure growth, does not get stuck up in the valuation game, and the other one does just the opposite.
Okay, so those are the top 10 funds that one can invest into. But you know what? I also want to talk a little bit about contrarian funds. Funds that have not performed well so far and have the potential to sort of outperform the market. What are the funds that you would look at there?
See, we looked at 6 categories, which are the more commonly diversified categories, in which we tried to identify the ones which are the worst performing for the last 1 year, and picked one each. And from there are 2 funds, HDFC Equity and Franklin India Blue Chip. These have been in the bottom quartile performance in the last 1 year. But if you look at how they are positioned today, for example, HDFC Equity, Prashant Jain has a lot of PSU stocks. Those have not run up. So our personal belief is, out of the laundry list of bad performing schemes, these 2 have a super potential to reverse the trend. For different reasons, but HDFC Equity, we had given a sell call 5 years back. I think the whole bad phase for a large scheme like that is over, and it is just at the trough, looking forward to getting into the peaks.
Okay, that's on HDFC Equity. I know, I mean, even their calls on not just PSUs on the whole, but PSU banks is something that has not worked well. But, well, let's see, things, the tide could turn. Anything else? Any other contrarian funds that catch your eye that one can invest into?
So I think, Sonia, we spoke of 8 schemes, which are the more conventional ones, two contrarian ones, which is Franklin and HDFC. Because if you take funds which have not done well, you need to be doubly sure whether you've gone into each stock. And that's where my confidence levels stays at these 2 for the moment. But if somebody actually wants to buy more of them, there are. But I think these 10 schemes should form a part of one's portfolio for the next couple of years. And I think beating the index by 3%. Per annum, assuming Nifty is your benchmark, should be reasonably possible and a high probability event.
Okay, so you've actually educated us a lot about what are the funds to buy, what are the criteria to look at. We are getting a lot of comments and questions on social media, and we don't have too much time, so I'm just going to take the one which is the most popular. Is this the time to be putting money into mutual funds, or should one wait for a correction? Now, a lot of the retail participants are feeling left out with such a huge rally, Feroze. Is your advice wait for a correction and then put in the money to work, or should one just go for it right now?
I think the answer is depending on the person's current situation. If you are less than 40% of your money in equity, you should go whole hog with whatever surpluses you have and get your asset allocation to 65. If you're already at 60, 65, then there is no hurry. See, that's where the answer lies. What is your current allocation to equity? If your net worth is largely sitting in debt, then you should go whole hog, because the next year's corporate earnings, if you go company by company, have a 30-40% growth potential on the lower basis which we have this financial year. So to answer the pointed question, go whole hog if you have not invested in equity up to 60%. If you have already, then you would probably stagger it over the next 3-4 months as some key events pass by, and we see the next quarter results after this financial year.
Okay, it was a pleasure speaking with you, Feroze. Thank you for answering all our mutual fund queries and helping us with the top 10 mutual funds to invest into in 2021. With that, it is curtains down on another edition of Smart Money. Thanks for watching. Have a great weekend.